All right, everybody, welcome back. So in this video, I want to talk about managing a trade. Netflix was going to report earnings yesterday, and it's one of those names that when it reports, this thing moves. It's been nicknamed an account killer because it exceeds its expected move all the time. And yet, because it's earnings, I don't like to put trades on that risk a lot of money, right? Because earnings are a gamble. You can run into them and you can trade after them, but if you're trying to put a trade on to guess what their earnings move is going to be, you're just flipping a coin, right? You might as well go to Vegas and get free drinks. But it's still fun to play them if there's a way to defend them, right? And that's what we're going to go through today. So, yesterday, I put on a put butterfly, right? So, this put butterfly was risking somewhere around 10 cents. I bought a put butterfly using the 350, 375, 325 puts. All right. So, we're just going to draw those out real quick. Now, the way options work, if you're, still trying to get familiar with them, is you can't be net short puts if your account can't afford what they represent, those 100 shares. So I couldn't just go out and like sell a naked put. All right. I have to cover that put somehow. If I want to sell two puts, I have to buy two puts. So this makes everything equal. I'm short two in the middle. I'm long one up here and I'm long one down there. And that's a total of four puts, two long, two short. So the whole thing was opened for $10. That's 10 cents. And I bought to open the butterfly and then they reported. And they didn't fall down as far as I would like them to fall down, right? I want them to get down here. The butterfly will profit if you're anywhere inside this zone, and you'll make the most money if price closes at that line. And we're talking by Friday. Well, that's not going to happen, right? We didn't get that kind of move. So now I'm out my $10. But I don't like that answer. So I thought, well, let's just go in today and let's fix this, right? Let's see if we can get the $10 back and maybe make a little extra along the way. So the first thing that I did is I bought back those short puts and I took them off the table. When you're trading options, you really want to know how much was those options inside that spread. So here I've got Netflix. You can see that on the 19th, the trade was opened. And what we want to look at are these two short puts, right? Because that was the two short puts from my butterfly. And then I bought this one and I bought that one. Those two short puts combined had 23 cents, right? That was the combined total amount of credit that I got when I sold them. And then I used that credit to buy these puts. Well, I sold to open, so I need to buy to close. Today, I bought back those two short puts for 2 pennies. That right there gave me a profit. But here's the problem. I still have 28 and 5 that I've spent, and I need to make that money back. When I closed these two short puts and I closed them for $2 a piece, that's $4. What am I going to do about the rest of this loss? I've still got these that need to be dealt with. That was $23, not 33, right? So $23, I buy them back for 4, that's $19 profit. Okay, so I'm up 19 cents, but I've still got to cover the 28 and I've still got to cover the 5. So I'm going to lose money in this trade if I spent 33 and I only made back 19. I'm looking at a $14 loss. I don't want to take a $14 loss on a trade that originally was only going to risk $10. So now what do we do? Right? In fact, why did I close those puts? Well, because I have a plan. The plan is to sell better puts, to sell something that has more credit in it. Well, remember what I said earlier, I can't sell a naked put, but I can sell a put if I'm holding puts, right? So since I've already got puts, I might as well sell one. When it comes to the put that I want to sell, I want to make sure I'm getting enough money to cover the risk and to make a little bit of profit. Now, I only needed 14 cents. So I could have sold something much farther away from price, but I kind of got in there a little bit. I sold the 415. We're at 434 and I sold the 415. So there's about a 20-point difference between what I sold and where price is. We're going to go ahead and mark that here on the chart where 415 is. Now, the way this works, as long as the stock price stays above the put that I sold, then this trade will monetize and make me money. That's all that I needed to do. And I don't need to get the entire $58 of credit that I collected. I really only need $14, right? But I've got all these commissions now because altogether I traded 5 legs, right? Not 5 legs, but 5 options. And each one of those options has fees and commissions. Now, maybe you don't, right? If you're using Robinhood or Robinhood Broker, maybe Webull, then you don't have the commission issue. But for the rest of us, when we trade an option, we got to pay fees and commissions. They're not exorbitant fees, but they're still costs that I would like to cover. So while I don't need the entire $58, I need to cover the $14 of risk and I need to cover those commissions and everything. So my napkin math or rough estimate was that I need to collect about 50% of the credit from the option that I sold. I sold it for $58. I need to get it back at around, let's call it $28. That's a good rough estimate. So where are we sitting at? Well, I just did this trade. We can see that it's 11:12 local time, and I put the trade on at 10:52 local time. So I haven't been in it very long. My short put right there has decayed $3, and so I'm up, right, $3. And we're just moving in the right direction. So what I'm really hoping to see is that support holds here around that 150 line and we get a green line crossover. This is kind of like a TRB setup or my failed flag play. We want to see this thing come out of this base with a rip to the upside, maybe completing maybe a bigger kind of a cup and handle looking position. Let's go ahead and take all of these lines off and everything. So we want to see this complete this basing down here and then come back around the other side, maybe form a cup, get a handle, that kind of thing. I don't need it to do that, right? But if it does begin to go up, then my trade will monetize even faster and I could really get out today and not have to worry about holding it until tomorrow. If not, if it doesn't complete that basing pattern, turn around and go higher, then I have to worry about it breaking down and going lower. With that in mind, what we want to do is measure out the 1, 2, 3, 6. And what we're going to be looking for here is that if it breaks down and it makes it through the 111, that'll open the 1, 2, 3, 6. We want to see if it gets tangled up into 1, 2, 3, 6 and stalls. If it stalls, then we have the potential for a rally. Otherwise, we'll take the entire measured move here and we will project that down 50% and then 100%. And that makes perfect sense, right? When you measure ranges, cup and handles, head and shoulders, wedges, anything like that, you want to measure out 50% of the move and then 100% of the move. 100% of this intraday move that I measured still only takes us down to 417.5, and my trade is sitting at 415, right? Actually, it's lower than that because I sold it for 415, but I got $58 credit. So my actual real break even is lower than that. It's at 414.50. It's close enough, right? Just doing some napkin math. So that's the position. Now, did I have to do any of this? No, I mean, really, no, I didn't have to do any of this. I could have just left the entire trade alone, took my lumps at 10 cents, and called it good. The reason I made the trade so small is because I had no conviction in it whatsoever. I just really wanted to participate. And I knew that if I did participate and it didn't work, that I was going to have some option, some choices at my disposal to perhaps turn this trade around and get something out of it, right? Why else would I be willing to put money on the line unless I knew that I had a chance of defending that trade, of defending the money that I was risking, and to perhaps turn everything around? Now, is there still risk here? Yes, absolutely. There is still risk. I could still lose money, but it's a low risk trade, in my opinion, which is why I went ahead and I did this. And I wanted to kind of break it all down here and explain what I was doing because I see a lot of people who are trading options as if it's a binary decision of win and lose, right? You opened it, it didn't work, and now you're closing it for a loss. There's nothing wrong with that approach, but try to consider what other opportunities you have to defend a trade that isn't working. We can't defend everything, or I should say, sometimes it's not worth the risk of defending everything. But if you approach the trade before you put it on with a mindset that you are willing to defend it, it will influence the strike choices and the expiration that you choose, right? Because if you choose the wrong expiration, then you might not be able to defend it. Or if you're in the wrong area with your strikes, there might not be a very good way to defend it. But if you are already thinking about defense before you get into the trade, then the choices that you make about what you end up trading will change and it will give you that opportunity. So that's what I got. I appreciate your time. And if you've got questions on this or just options in general, reach out to me and you know, ask away.